Hey, hello, and welcome everybody. This is our regular StanLib monthly webinar series. So a very warm welcome to you all across South Africa. I'm sure you're all hoping it is warm because it certainly has been a very cold couple of days across the country, but probably not as cold as it often gets for our participants in London. So we're today welcoming in the room our strategic partner, JP Morgan. We've obviously had an integrated partnership with JP Morgan since late in 2021. And we've been going around the country chatting to all of you around the various ways that we've been integrating their expertise and investment pedigree into our business, but also how we've been bringing some very interesting and new product to the South African market. So we're very glad to have this ongoing partnership with them, and that's been about 10 months now. So on the call, we have welcome to Michael Bell, who is one of JP Morgan's global market strategists, as well as Carolyn Keane, who is the portfolio manager for the JP Morgan Global Growth Strategy, which is the strategy now that the StanLib Global Growth Fund actually drills down into. So we're going to have an opportunity then today, because we have both of them on the line, to upfront chat to Mike a bit about the global macro background and a little bit of a dive into where we are at the moment in that sphere. And then in terms of Carolyn is going to chat to us a little bit about the portfolio in the global growth sphere, and how herself and Alex Stanek, who's a co-portfolio manager with her, have been navigating the current environment in what was probably the darling of the last 10 years growth, and how they've been coping over this period, and what they foresee for the future. So some interesting stuff to chat through when we get to that. So just some housekeeping up front. Obviously, please do fire away with chats in the chat box and any questions. I'll be monitoring that at the end of each section. We'll have an opportunity to chat to both and ask a few questions, and then we'll have a sort of summary question time right at the end. So if I don't get to some of your questions, I'll try and make sure that we get through them right till the end. But if I can ask then for Mike to come online, and very warm welcome to you, Mike.
Thanks very much, and good morning, everyone. Yeah,
I suppose I wanted to just say, I think an interesting one that I thought we could just mention up front is that the intro actually, or headline for this webinar, was navigating a low growth, a high inflation, low growth environment. And I think in our discussions, what's been really interesting is seeing how, that might be the environment we're in right now, but over the last 2 years, it's gone from sort of a extreme recession to sort of great returns to stagflation to inflation. So it's a lot going on, and it'll be nice to hear you chat through a little bit of where we think we might go in the next sort of 6 to 9 months.
Thanks, Sarah. Yeah. And I mean, you mentioned that normally the weather's not great over here in the UK. We've actually just had an absolute heat wave. It's been amazing. But there's one thing you can predict about the UK, is that it won't last. And, certainly the economic data is starting to look somewhat chilly. So if we bring the slides up, please, and skip to slide 2. This shows you what's going on in both the Eurozone on the left-hand side and then the UK on the right-hand side. And what it is the consumer confidence surveys, which are in purple, and then in grey, the business surveys for the service sector, which make up the bulk of the economy in both the UK and Europe. And you can see that historically, these two things move together. So business and consumer confidence both fall and rise together. And what's going on at the moment is that because of the enormous increase in energy bills that is pending for most people in Europe, by the time we get to this winter. Consumer confidence is just rock bottom, as you can see, basically at the kind of levels that we've only seen historically in recessions. The business surveys are holding up a bit better. So the 50 line there is historically the difference between expansion and contraction. So when that gray line is above 50, it tends to mean the economy is expanding. When it's below 50, it means it's contracting. So the consumer confidence surveys are weaker than the business surveys at the moment. But as you can see, historically, when you get such weak consumer confidence, the business surveys sadly tend to follow them downwards, which is what the most recent data seems to be suggesting is ongoing. So, I would say that these high energy prices that we're seeing in Europe and the UK, because of the war in Ukraine and the impact that's having on Russian gas supplies to Europe, does significantly raise the risk of a recession in Europe and the UK. To give you a little bit of detail on that here where I am in the UK, if you look at the next slide, we have what's called an energy price cap. And what that is just every 6 months at the moment, and then from next year, it's going to change to being every 3 months, the regulator sets the cap on the amount that you can spend on your energy bills. It's per unit, so obviously depending on how much you use, the price varies, but it's for average usage, a cap on the rate per unit. And you can see that the average household in the UK was spending about £1,200 a year on their energy bill back at last winter in January 2022. That's gone up a little bit over the last few months to just below £2,000 a year. But come this October, so when it gets to winter and everyone's going to need to be heating their homes as things cool down a lot, you can see the expected increase in that energy price cap, and about 70% of people on the UK are directly on that energy price cap, is going to increase very, very significantly. And then in January, it's expected to increase even more. So that actually, compared with where we were last winter, by January, energy bills in the UK are probably going to be about 3 times as high as they were last winter. And that's a problem. That's why you've got consumer confidence so beaten up. And it's not just the fact that energy bills are going up so much. You've also got rising interest rates because the central bank is looking at what's going on in terms of inflation. Not only the fact that high energy prices, but also that wages are picking up quite strongly. Wage growth is indicated to be rising somewhere between 5 to 6% at the moment in the UK. And to deal with that underlying inflationary pressure, they're putting interest rates up. So about half of mortgage holders in the UK are either on a tracker mortgage, which means that they feel the increase in interest rates straight away, or on a 2-year fix. About 30% in total are on 2-year fixes. But of course, those fixes come to an end. And so if you'd fixed 2 years ago in July 2020, which is what I'm showing on the chart on the right-hand side, you would have been paying 1.5% on your mortgage if you had a 75% loan to value. If that 2-year fix had just expired 2 years later, i.e. today, then you'd now be paying more like 3.5% to fix for the next 2 years. So UK consumers are getting hit by a double whammy of significantly higher energy prices and an increase in their mortgage costs. So I think that recession risk in the UK and Europe is elevated. Now, of course, in the UK, there's the ongoing battle between Rishi Sunak and Liz Truss as to who's going to be the next prime minister. It will be interesting to see. The favorite is Liz Truss. The bookies have her as pretty strong favorite. I don't think that the amount of fiscal stimulus, in other words, support that either Rishi Sunak or Liz Truss are currently proposing would be enough to help out consumers, given the extent of this squeeze from higher energy bills that's coming. Of course, they could do more, But if they were to do more fiscal stimulus than they're currently proposing, and it was enough to prevent a near-term recession, well, then the risk, of course, is that with wage growth rising as strongly as it is, the central bank feels it needs to keep on putting interest rates up, and therefore that squeeze from higher mortgage rates could just intensify. So either way, I think that sadly the Bank of England and policymakers in the UK are kind of stuck between a rock and a hard place. Let's move on and talk about the US on the next slide. And I would say that it's a similar challenge really in the US to what it is in the UK, that the policymakers, particularly the central bank, are stuck between a rock and a hard place, because what's going on is wage growth is very, very strong. As you can see here, the purple line on this chart is the Atlanta Fed's measure of year-on-year median wage growth, which I think is the best way of looking at wage growth in the US. And it's extremely strong by historic standards because unemployment is the lowest it's been in over 50 years. And faced with higher petrol prices, higher inflation in general, consumers and workers are saying to their bosses, we need a big pay rise. And interestingly, they're getting them at the moment. Not enough to offset the squeeze from higher inflation, but nevertheless, pretty strong pay rises. And of course, what that's doing is causing the central bank to feel like they need to put interest rates up to try and dampen those wage pressures and bring underlying inflation pressures back under control. The problem is that historically, in order to get those wage pressures down to a level that's more consistent with inflation at target of 2%, has required workers to have less bargaining power. In other words, for the unemployment rate to go up. And when the unemployment rate starts to rise, it tends to keep on going. It doesn't tend to just rise by 0.1, 0.2%. When it starts to rise, you tend to get a recession. And so I think unless wage growth can come back down to something like 4% on its own without unemployment having to go higher, it's going to be hard for the Federal Reserve to engineer a so-called soft landing where inflation comes back down to target without there being a recession. Now, if you look at the next slide, you might think, what on earth am I talking about? Where's the recession risk? Look at the left-hand side chart. Payroll growth, this is the change in the number of people on payrolls in the US, extremely strong. You can see the red line on the left-hand side chart is the level of payroll growth we tend to get to just before a recession, and we're way, way above that. So that does suggest that even with the couple of quarters of negative growth that the US economy has seen, we're not in recession just yet. Look at the chart on the right-hand side, and you can see that the ISM Services Survey is also above the level that historically you see before we go into a recession. It's tended to hit about 52.5, and we're well above 55 at the moment. So these two indicators paint a picture that says, actually, recession risk at the moment is not that high in the US. However, if you look at the next slide, there are some other indicators that paint a somewhat more concerning picture. The chart on the left-hand side shows you initial jobless claims, number of people filing for unemployment benefits in the US. And you can see that it started to rise, albeit from very low levels. But historically, when the number of people signing on for jobless benefits starts to increase, that has sometimes been a warning sign that the economy is starting to deteriorate and has often been a precursor for recession. The other thing is the service sector is more than 75% of the US economy. You look at that chart on the right-hand side, the purple line is the service sector survey that I showed you on the previous page. The gray line, though, is the other big service sector survey that people follow. And you can see that that is now down below the 50 line. As I said, below 50 tends to mean contraction, above 50 means expansion. And so you're getting a mixed picture on the outlook for the most important part of the US economy, depending on which survey you look at. And historically, the gray line on the right-hand side, the Service PMI survey, that has a greater focus on some of the more forward-looking components of the survey. And so, at best, you can say that there's a mixed picture there rather than the bullish story painted by just the purple line. If we move on to the next page, the other things that make me just a bit cautious about sounding the all clear and saying that the recession risk has gone away is consumer confidence. This looks at the present situation component. In other words, when they ask people, how are you feeling about how things are going for you right now, compared with where it was a year ago for the Conference Board's Consumer Confidence Survey. And people are feeling worse today than they were a year ago. And as you can see, historically, when it gets down to that red line, that has tended to be a precursor for the onset of a US recession. Likewise, if you look at the manufacturing sector on the right-hand side, this is a survey of manufacturing businesses asking them, are your new orders increasing or decreasing? Again, below the red line of 50 means that they're decreasing. And you can see that from booming levels 12 months ago, they're now down at levels indicative of a contraction in manufacturing activity. And then the final indicator on the next page that I want to show you is housing. So the housing market has come under pressure because during the last recession, during COVID, house prices went up about 40%. Very unusual. Normally in a recession, house price growth slows down. This time around, house prices went up a lot. And then the 30-year mortgage rate in the US has gone up very significantly from below 3% to closer to 6% today. And what that's doing is it's leading to a sharp fall in the number of homes being sold and a decline in the number of homes being started to be constructed. And again, as you can see, historically, those have been things that happen before recessions. Finally, on the right-hand side, you've got the Conference Board's leading economic indicator. This is 10 different economic indicators, including some of the ones I've just shown you, agglomerated into this one line. And again, you can see historically, it's done a pretty good job of warning of turning points in the economy. And at the moment, is starting to point down, indicative that the risks have not gone away for the economy. So what does it all mean? We look at the next slide. One thing I would say is, given those risks to the growth outlook, I think, and particularly what's going on with the housing market, it's unlikely that the Fed and central banks are going to be putting interest rates up by much more than is already priced in. The market already thinks that the Fed are going to get interest rates
Hi, everyone. I think we've just lost Michael. So if we can just pause and give us a moment while we get him back online. Thank you. Hi, sorry everybody. It seems that we've lost Mike, so we're going to carry on with Carolyn Keane now, and then once we've got Mike back online, he'll finish up. He was very near the end, so we haven't lost out on too many slides. But I'm going to ask if we can click over to Carolyn's presentation, and we can begin the discussion around the Stanlib Global Growth Fund. And how that is being managed inside of the JP Morgan Global Growth Strategy. So if I can just ask for them to put the slides back up. Hi, Carolyn.
Hi, Sarah, and hi, everyone. Good morning, everyone. So as Sarah mentioned, I'm going to talk to you about the Stanlib Global Growth Strategy today, which drops into the JP Morgan Global Growth Strategy that I co-manage. And here are the slides, so fantastic. So I think it's been so far a very helpful perspective to have Mike's economic backdrop. I think it's especially interesting talking about growth stocks today, which are less dependent on the macroeconomic cycle for growth, given that there do look like there's a lot of leading indicators which are weakening. So if we go to the first slide, please. As a reminder, our central premise with our approach to growth investing is based on the fact that over the long run, earnings growth is the key driver of equity returns. So given that, the key thing that we look for when we're putting stocks into the portfolio is the company's ability to deliver sustained growth that's less dependent on that macroeconomic cycle, and companies that have a strong market position. We're also looking for businesses that have financial strength, and this helps them weather any economic weakness that may occur. And if they can continue to invest through any weakness, they are more likely to be able to emerge stronger than their competitors on the other side. We're also looking for ESG credentials, which are additive to both the growth aspect that we're looking for and those quality aspects that I've mentioned too. And last but not least, we're looking for value creation over the investment horizon. And I mean that this is in two senses that I mean this. So firstly, we're looking for companies that can grow with high incremental return on capital, so that it's able to achieve value creative growth. But we're also looking to buy that growth at a discount to the intrinsic value. So looking for high expected returns. That means we're creating value over the investment horizon for the unit holders in the fund as well. So let's dive into the sustained growth point a little bit further. If we can go on to the next slide, fantastic, thank you. You can see here that we use long-term structural themes. Now these themes are multi-cycle in nature, and they help guide us towards the best areas of long-term growth. Now, these themes all remain very relevant today, and maybe even more so today, despite the fact that we have seen a growth sell-off so far in 2022. And each theme remains represented in the portfolio. If we can go on to the next slide, please, bring it all together. The top right-hand boxes show that a snapshot of the fund at any point in time. So this is how the fund should look at any point in time. You can see there that the growth is at a premium for the strategy versus the index. Now, the index is the MSCI ACWI Growth Index. And I want to point that out because that 12.7% EPS growth forecast for the next 5 years is a pretty high hurdle to beat. So the strategy has to maintain a premium to that growth, which it does. It's got a 15.3% expected growth CAGR, so compound annual growth rate over the next 5 years, which is our internal analysts' forecasts. Then there's the financial strength aspect that I mentioned. So you can see there's no debt in aggregate for the companies in the strategy, whereas the index has got gearing. Then in terms of that value creation, we see a high ROIC for the strategy at 16%. And then in terms of valuation, there are a couple of points premium in terms of EV/EBITDA multiple compared to the index, But we don't believe that that's the full story. We don't believe that means it's expensive. In fact, when you look at the expected returns for the portfolio versus the index, we think actually we're buying these stocks at very good value. And that higher EV/EBITDA multiple is really a reflection of the stronger growth and better quality of the businesses that we're buying in the fund versus the index. Now, turning to performance, we have had a tough period of performance since the fourth quarter in 2021, when the market rotated out of growth stocks. And that has continued so far year to date in 2022. Now, we've underperformed a growth benchmark because we have been positioned in higher growth stocks than the benchmark. So this fund has been more growthy than the growth index. And growth, the highest growth companies are the ones that have sold off the most in this rising interest rate environment. The good news is that the performance has actually improved more recently. We outperformed in July, and we're very confident in the long-term positioning of the portfolio going forward. So if we can move on to the next section now, please. The next slide, please. Thank you. I'd like to recap on the environment that we've been navigating so far this year. I think it's helpful to think about the long term, and we do have a long-term investment horizon of 5 years. So if you look at the chart on the left-hand side, you can see the annualized returns over the long term from equity markets globally. And this is the period of 2007 to 2021. And it's important to highlight because that does include the global financial crisis. It also includes the growth slowdown of 2015, 2016. And despite that, we have had these attractive returns over the past number of years on an annualized basis. The second point I want to make backs up our approach to growth investing, that earnings is really the largest component of those equity returns, so that pink bar there. And that is why we're so focused on that sustained earnings growth potential from these businesses. On the right-hand side, we can see for 2022, that the equity market weakness has really been driven by de-rating. So that's multiple contraction, the PE multiple, the price that the market is willing to pay. Whereas actually in the main, so far, earnings have held up. Now, this is the key debate going forward, is whether that earnings can continue to grow, or whether due to that macroeconomic outlook that Mike was painting, earnings could potentially be weaker or having a period of weakness. And again, this is the reason why we prefer growth equities that are less dependent on the macroeconomic cycle for their growth. Another way of having a look at the de-rating, if we can move on the next slide, please. You can see the Russell 2000 Growth Index. So this is the 2000 growthiest businesses in the US. And as you can see, the average PE multiple over the past number of years is around 32 times, which is a reasonably high number, but understandable given the growth. These are growth businesses. But what you can see is that it really departed from that average at the end of 2020 into 2021. And that multiple did get rather excessive. But what we can also see is that multiple has contracted pretty swiftly. And we are now well below the average level at 20 times earnings, which is indicative of the much better starting point for growth equities that we have today compared to last year. We can also see this from a single stock perspective. If you go on to the next slide, please, we can see the multiple of Amazon. You can see on the left-hand chart that EV/EBITDA multiple of Amazon is currently about 1 standard deviation below its long-term average. And that is looking very attractive to us. And we do have Amazon as our second largest active position in the portfolio. I also want to make a wider point about this chart, that while in the short term, the sell-off in growth equities can be driven by those rising interest rates, over the longer term, the picture is a bit more mixed. So for Amazon, what I'm trying to say here is that we don't think necessarily a higher level of 10-year yields will necessarily impact Amazon from executing on its growth strategy. And key really for the stock and the multiple that the market is willing to pay for the growth that Amazon can provide is that execution on the fundamentals. And this is really important. This is why it's really important to take a long-term view. And if we can move on to the next slide, I'll show you why I'm saying that. So this is the price drawdowns versus the subsequent next 5 years of growth for a business called ServiceNow, which is a US SaaS business that we own in the portfolio. Now, clearly, any period of significant drawdown can be and is very painful to live through, but adopting a buy and hold strategy, if you're confident in the fundamentals and if you're confident that that growth can come through, can be extremely rewarding. So if you look at, say, just May 2016, we suffered a price drawdown of 42%, which is higher than the current drawdown. So yes, very painful. But if you had held on to that position for the next 5 years, that increase in price appreciation absolutely dwarfed that 42% drawdown, as the stock went up 972% thereafter. And that's because the business continued to execute. So over that extended period, sales grew 35%, that's 8 times. Earnings grew 74%. CAGR, so that's compound annual growth rate, that's up 16 times. And the gross margin reached 82%. And the free cash flow margin for ServiceNow is actually over 30%. So this is a very cash generative, high growth business. And we still have this stock in the portfolio today, despite the current drawdown. So if we can move to the next slide, I want to talk through some activity year to date and how we have been navigating the year so far. So in light of the heightened volatility that we have seen, and the increased betas of many individual stocks, we have moderated position sizes, but retained exposure to the key long-term themes, especially within the digital revolution theme. So you can see that on the intensifying trends part of the page on the right-hand side. These quality businesses, such as Microsoft, Amazon, MasterCard, SolarEdge, we believe they still have huge growth runways ahead of them. But what we've done on the other side is we've added new positions into the portfolio, which have diversified sources of earnings growth. So for example, Deere, which is digitizing the agricultural space in the US mainly, but it's a global company. They have their smart tractors and smart machinery. We've also bought Sika, which is a leading building materials manufacturer that specializes in sustainable building materials. Now these stocks we've been watching for some time. They had been too expensive for us. They hadn't met our return criteria. However, with the recent sell-off, they have met those hurdle rates and we've been able to buy them into the portfolio and diversify the source of growth. If we move on to the next slide, we can see the top 10 positions in the fund. So the largest active weights, now this is active, that means a position is on top of what is held in the benchmark as well. MasterCard and Amazon. These are 2 quality stocks. We've got very high expected returns for those businesses, so we think they're very undervalued. And they're driven by the structural themes of, in MasterCard's case, the digitalization of cash. And in Amazon's case, it's the shift to public cloud and the increasing penetration of e-commerce. The next 8 stocks represent growth from many different areas of the economy. So we've got medical robots for Intuitive Surgical, animal health and vaccinations for Zoetis, education, we've got semiconductors, so quite diversified range of earnings drivers. And you can see that again in the sector positioning on the next slide. So here is the portfolio in terms of the absolute and active sector positions and the country positions. So in terms of the sector, you can see that the largest portion of the fund is in the information technology space, which captures a lot of our long-term themes. You might think that 37.5% is quite a large weighting towards one sector, I would note that this sector is actually quite diverse, so it's not all one bet on kind of consumer electronics cycle anymore. It's actually made up of quite diverse drivers within technology. But the other point is that the benchmark has a very high weighting towards IT, and that's because it's the MSCI ACWI Growth Index. So we have a small overweight to information technology. It was higher at the beginning of the year, but as I mentioned, moderating those position sizes due to the increased volatility. We now have a smaller overweight. We have increased our healthcare positioning, so that's the highest active sector weighting in the portfolio today. And it's not very low growth companies, as you would expect, given this is a global growth fund. We have companies like Intuitive Surgical, medical robots business there, where our expected 5-year growth CAGR for that business is almost 20%. On the other side, we are most underweight industrials and consumer discretionary. And given the kind of desire to be less tied to the macroeconomic cycle, I think that would make intuitive sense to you. From a country positioning, it's more driven by a bottom-up stock selection than necessarily a top-down macro view globally. And we do find most of those businesses that meet our hurdle rates for growth in North America, so that's 70% of the fund. Distant second would be Europe and emerging markets. If we go on to the next slide, please. These are the subsector positions. So what I want to really mention here is that where we don't like a particular sector for reasons that doesn't meet our growth and quality criteria, we're not going to buy a stock in that subsector just to kind of cover it off. So if we don't like it, we will not own it. However, we're not completely stuck in our ways in terms of never changing our mind about sectors. So recently we have actually bought stock in the real estate sector, which is Equinix, a data center REIT. We've also bought an energy company, Hess, which is one of the only energy stocks out there that is growing through production growth. So we are able to be nimble in terms of our subsector positions where those stocks meet our long-term criteria for sustained growth and quality aspects. So on the next slide, I'd like to just conclude with a brief outlook. We are expecting continued volatility. There is a huge amount of uncertainty when it comes to the macro, and that for us makes it very difficult to attempt to kind of trade around this, and we take a completely different approach. We're focused on buying value creative growth companies that are less dependent on the macroeconomic cycle, and we want to buy those companies at a discount to intrinsic value. So in the short term, we think prices are going to continue to move around, but what we do see is that there are attractive expected returns emerging in many stocks, and actually many stocks entering the territory where we think they can actually double on a 5-year view. And we believe that that is a much better starting point for global growth stocks than they have been in the more recent past. So the last slide, just to summarize, that the Stanlib Global Growth Strategy is a high conviction portfolio of 44 stocks. We're invested in businesses where we have long-term structural growth prospects and the ability to produce value creative growth. And we're backed by a large research franchise at JP Morgan with a vast investment experience.
Great, and thank you so much, Carolyn. I'm going to maybe just make one statement before we quickly click over to Mike, before we finish up one or two of his slides. And that is thanks again for sort of interchangeably speaking about JP Morgan's Global Growth Strategy and Stanlib's Global Growth Fund. I'll just reiterate, Stanlib's Global Growth Fund buys only into the JP Morgan Global Growth Strategy. And of course, in South Africa, you can have access to that in a US dollar fund or in a straight ZAR feeder. So thanks, Caroline. I think it ended on a good note there, chatting about good valuations. I certainly think everybody's looking forward to a time where we can see those types of growth stocks at fair value, and we can begin to get excited again about this environment. So I'm going to just quickly pause you and click over to Mike. We'll just finish up his last 3 slides. So we were on slide 9, Mike, and welcome back. Sorry for the delay there. Little bit of technical difficulties there, but great to have you back. And then Simone, if you can just pop up that slide and click to slide 9.
Thanks. Yeah, sorry about the technical issue. So if I'm right that some of these economic indicators are rolling over, it seems likely to me that interest rates are not going to rise by much more than is priced in. You can see from this chart, the market already expects the Fed to get interest rates up to about 3.5%, the Bank of England to get rates up to about 3%. In fact, I think as of this morning, it's even higher than that. And so if the combination of higher energy prices and these higher interest rates do end up causing a recession, then it's unlikely that interest rates are going to rise by more than is already being priced in. And then when we do get a recession, interest rates are likely to be cut. Now you can see the market is already pricing that there's going to be some cuts in interest rates. The Fed are expected to get rates up to about 3.5 and then bring them down to just above 2. But if we get a recession rather than a so-called soft landing where a recession would be avoided, then I think that actually interest rates would fall by more than is being priced. Rather than falling just down to 2, they could fall all the way back down to the 0 lower bound. So rates unlikely to go much further than is already being priced in. And we've got the likelihood that rates could end up actually being cut by more than is being priced as well. Now, on the final slide, which is slide 10, I just wanted to make the point that if we do end up getting a US recession, it's not likely to be as bad as 2008. So in the run up to 2008, you can see on this chart, the blue line is residential investment. There was an absolute boom in housing construction in the approximately 20 years running up to 2008. What hasn't happened this time around is that boom in housing construction. In fact, in the wake of the financial crisis, there was a decade-long period where residential construction was below the long-run average. Now we're back to kind of long-run average levels of home building at the moment as a percentage of GDP, but not in the kind of overbuilt territory that we were in 2007. So even though I showed you a chart that showing that the housing market was coming under pressure because of higher interest rates and higher mortgage rates, I don't think it's going to cause the same kind of bust that it did in 2008. It may well be enough to cause a recession, but a less deep recession. And another one of the reasons why I think that recession would be less deep is because I don't think it would morph into a financial crisis. Because in the run up to 2007, you had a lot of people who were subprime borrowers who had been lent lots of money, subprime mortgages. In the last decade, there's been very little subprime mortgage lending at all. So the other thing is that the banks are much better capitalized than they were. So even if there are some losses for the banks, the likelihood of it wiping out the banking system in the way that it did in 2008 is much, much lower than it was back then. And the final point I would make is that even though people moving home are feeling the fact that mortgage rates have gone up a lot in the US, people who don't intend on moving in America, they're not really noticing. 95% of all mortgages in America are fixed for the long term, for at least 15 years, and about 80% are fixed for 30 years. So it's not like here in the UK, for example, where people are only fixed for a couple of years, and as the interest rates go up, and those fixes end, they feel those higher interest rates. In America, it's home sales coming under pressure because when you move home, you feel the higher interest rate. But if you just stay put and don't move home, then you're not feeling that squeeze from higher mortgage rates in the same way. So I think it could still cause a recession as home sales and then the related building activity and, you know, money for estate agents and the money for all the shops that sell the furniture that go into new homes. As that kind of stuff slows down, it could cause a recession, but it's likely to be a much more moderate recession than the type you see when you get a financial crisis like we saw in 2008. So a relatively cautious economic outlook, but even though recession risk is relatively high, I think, not forecasting a 2008 type financial crisis. So let me wrap up on that point.
Great, thanks, Mike. All right, we're just going to take 2 seconds. If you'd like to also follow Mike on LinkedIn, great content coming from his desk. You can copy that little LinkedIn sticker there and continue through and follow him. But thanks, Mike. That's great. And I think you ended on a very important point, and one I think we've been chatting a lot about is the likelihood of a recession, and then, of course, if that does come through, the degree to what we can expect that. I suppose the question also at this stage, at the Bostic expectation, or that we would have a Fed pivot in September. I mean, that's probably long gone and long out the way. But I suppose you spoke a lot about the likelihood and the fact that your view is that there is still a likelihood of a recession over the next sort of 12 months. That degree, interestingly, of course, to look at the extreme negative sentiment that often comes when we begin to talk in the market about recession. I always find people kind of look back at the previous recessions, so really good to talk through the housing market and show signs of why we wouldn't have sort of such an extreme crisis as we did in 2008. But I suppose one of the few questions that's sort of outstanding is, there's been a lot of comparing this cycle to the 1970 cycle of kind of inflation that continually rebounded. And it maybe ties in with one of our last questions we've had here from Grant Brand around, what's the expectation that you could, even with, continued, as you've said, sort of interest rates reaching these types of high levels, recession coming through, that you still continue to get inflation bouncing back?
I think it's quite unlikely. So in the 1970s, you had quite a lot of wage indexation, in other words, and unionization as well. And so when inflation was high, for some people, it automatically fed through into their wage negotiation settlement. And for others, unions were saying, they were much more powerful than they are today, saying, well, look, inflation is still high, so we need pay growth. And so the wage pressures and the inflation pressures were more sticky than I think they will be this time around. I think inflation pressures and those caused by underlying wage growth are going to be very sticky until workers don't have bargaining power anymore. But when that bargaining power goes away because unemployment rises, then I think wage growth will come back down and the inflation pressures will moderate. So I think that's the key difference between the 1970s. You don't have the same degree of automatic feed through in terms of wage indexation, where it was literally built into people's contracts that they would get kind of cost of living adjustments in their wages, and unions are much less strong today than they were back then. So at the moment, workers can bargain for strong wage gains because there's hardly anyone out there who can do their job. But if unemployment rises to, let's say, 6 to 7%, which is kind of what I would think is the most likely outcome, less severe than the 10% or 15% unemployment rates we saw during the financial crisis or COVID, but still a increase in unemployment, then I think people will be glad to have a job and willing to accept lower pay rises, particularly if inflation then comes down during a recession, because recessions tend to lead to a decline in commodity prices and a lot of the inflation could dissipate in that way. The one scenario in which inflation could stay high is if commodity prices just kept on going higher and higher and higher, and even with a recession, the commodity prices were causing headline inflation to stay high. But the more, commodity prices are probably already at a level that are likely to cause a recession, there comes a point where if inflation caused by commodity prices just keeps on getting worse and worse, it becomes self-defeating. And of course, people say, oh, but what about the lack of oil? What about if Russia stops exporting all of its oil? But we just lived through a nearly 2-year-long period where no one traveled to work because of COVID. If oil prices were $200-300 a barrel, then I'm pretty sure that people would just start working from home. Bosses would be forced to say, you got to work from home. And we saw what that did to demand for oil during COVID. So commodity prices in that type of environment can come down just as quickly as they can go up.
And maybe, Mike, at that point, I'd like to ask another question. And I think there's been a few, and maybe I can kind of lump this into kind of one question around, energy and the crisis in Ukraine. I mean, I think, typical of these types of crises, there's a lot that happens in the market in terms of talking about the effect in the beginning, sort of 6 months down the line. Where are we right now with that war? And what's the view in terms of that? There's views, of course, around this being a much more extended war. There's views around the possible, more negative views around it becoming worse and becoming something of a European war. Any views around that?
I think it's unlikely that it becomes a full-blown European conflict with Russia. I think that neither side really want that militarily. It would be disastrous, given that Russia has nuclear weapons, and so obviously do NATO. So I don't think that should be the base case. But I do sadly think that the likelihood of this war dragging on is now quite high. And what will be interesting, and I don't know how this is going to pan out, but as these energy price hits really come home this winter, when it really becomes apparent to consumers, as those energy bills increase, as we get to October and people need to start heating their homes, because as I say, we've had a heat wave over the last few weeks. No one's really had the heating on. But when it gets cold and the gas prices are much, much higher, is that going to change the political calculus in Western Europe as to how they deal with the war in Russia, Ukraine, whether they become more willing to try and strike some kind of bargain with Putin? I don't know. Obviously, politically, there's lots of reasons why that would be very unappealing, but it's one potential outcome, given just how damaging those higher energy prices could end up being to Western European economies.
Yeah. I suppose the last couple of questions, I'm just going to kind of skip through the UK specific ones, but I mean, on that point of energy crisis at the end of the year, it's probably likely that that politically things get a bit heated, particularly at tough times for people on the ground. So it'll be interesting to see how that plays out. But maybe to leave you with the one last question is just around, bringing in the US to that. And I suppose the question here is specific to the US, but I think it's more around the indebtedness of the world. So it's speaking obviously to the recent Biden spending packages with money that US does not have. What's the view around, that indebtedness? And I think it speaks a lot to your concept around the fact that, interest rates can't go much further than this. Maybe just one or two comments on that.
Yeah, I think it's true. And I mean, I do think it's bizarre to call more fiscal stimulus in a tight labor market an Inflation Reduction Act, because I don't think it's going to help bring inflation down. If anything, it might cause it to be a bit higher. But ultimately, the debt levels, particularly the level of house prices relative to incomes in America and in many other Western economies, do, I think, limit the extent to which interest rates can move higher. So people saying that interest rates are going back to where they were in the 1970s, just imagine what would happen to housing markets if you put interest rates into double-digit territory. It would be a complete disaster. So there's no way that's going to happen. So interest rates, I don't think will go as high as some people fear, but the debt levels, historically, how do you get out of having so much debt? Well, you can either have defaults, which are disinflationary and tend to lead to depressions. That's very unlikely in economies that can print their own money. More likely is that if you take a long-term view and look through this recession that may be coming, that ultimately when we're in the next recession, they cut interest rates again and potentially even start printing more money. And so that ultimately it does argue for, on a very long-term view, a world where inflation could be higher, because that has always been the way that governments that have their debts denominated in their own currencies get out of debt problems. They get out of it by devaluing the debts, by printing more money.
Great. Thanks, Mike. We're going to click over to Carolyn and just ask a few last questions on the actual portfolio itself. Thanks, Mike. Great, Carolyn. So we've had a little bit of a chop and change between yourself and Mike. So I think everybody's got to sort of click over now to think about global growth. I thought, one of the key things we wanted to really highlight as well is, the depth and breadth of your team. So one of the questions as well that comes up is around how do you cope with this very, very large investable universe, and what sort of resources do you have to kind of cover that in terms of it being, the full JP Morgan team to do so?
Yeah. That's a very good question, Sarah. Thank you for that. So myself and Alex are managing the portfolio, but we're not doing all of the research and all of the stock analysis by ourselves. That would be a huge feat and a huge task. So we're very lucky at JP Morgan Asset Management to have a very strong and deep talent pool where we have 90 regional analysts and 8 global sector specialists that we can tap into. And all of the research from all of these people is available on one central database, which we call Spectrum, where we have got full visibility into all the analysts' earnings forecasts and the expected return that they believe that the stock is capable of generating. So we can really have very, very full transparency into the stocks and the numbers. And then, of course, we have conversations with these analysts on a regular basis in order to kind of talk through how they're seeing their sector. So the way it's organized is the 8 global sector specialists look at their sector on a global basis, and they help us therefore kind of navigate the world in terms of those long-term themes. Where would we like to be positioning the portfolio, and where are they seeing the most value, and which part of the value chain within their sector is the best place to invest on that kind of 5-year view. The regional analysts are based around the world. So we're, again, extremely lucky to have local analysts based on the ground, say in Asia, really talking to local counterparts, whether that's being able to do channel checks on the ground, obviously speaking the local language, so Mandarin speakers, for example, in the case of China, and also a big number of analysts in the US. So these regional analysts really tapped into what's going on right now, and they have a huge amount of depth in terms of their research and their forecasts. And we can have regular conversations with them as well to talk about in depth their ideas, which stocks they think are looking the best value, and where we should be investing again on that 5-year view. So we do have a lot of research capabilities, and it's Alex's and my job to filter that down and make sure we're very specific in terms of our hurdle rates at the strategy level. So that's sustained growth, strong market position, the financial strength, the ESG credentials, and the value created growth, in order for those stocks then to have to meet those very strong criteria to get into the portfolio.
Great, thanks, Carolyn. maybe you touched on that ESG concept, and I thought, in the interest of a lot of conversations in the market around that, maybe you could give us a stock idea just around what you have exposure to in that sort of going green space.
Yeah, exactly. So I think the ESG point is an interesting one. Obviously, we have an integrated ESG approach for this fund. This is not an ESG fund, but it does actually have a very good AA MSCI rating on an ESG perspective. But we can also use the ESG theme to find areas of future growth, and going green is one that we all hearing about. In fact, Biden's Inflation Reduction Act, as we've been talking about, has got a significant portion of funds allocated to helping to build renewable capacity in the US. So we're very conscious about where we're investing in the value chain. We're not going to buy any stock simply because it's thematic, and we are also very skeptical of just faddish growth. And we want to make sure that, therefore, there's sustained growth, but it's also value creative growth. So within that, we have a stock called Samsung SDI, which is one of the major battery manufacturers for EV batteries. And actually, if you look at an electric vehicle, a third of the value of that car is in the battery. So this is a really important area to invest in, and it's a key component. And we think, therefore, that these battery manufacturers have much more bargaining power than the market necessarily believes, because it's not traditional. That's not the way it traditionally goes. The traditional auto OEMs seem to have all the power, but that's not the case with the batteries. So that's one stock we have in the portfolio. We also have a solar inverter manufacturer called SolarEdge. Again, we looked at the whole value chain in terms of solar, and solar panels are actually a very commodity type product. We're not interested in investing there. But the inverters are much more technical, and there's a duopoly in terms of the types of inverters that SolarEdge make. So they've got a leading market share, 60%. So again, that goes back to that strong market position we're looking for, make high margins and good return on that investment. And again, this is an area that's growing very strongly. And I think the energy crisis that we're seeing in Europe and also around the world is also prompting people to think, actually, would I like solar panels on my roof? Would I like to be more independent in terms of my energy generation because of that energy security aspect? So they're two examples of stocks that we have in the going green theme.
Great, thanks, Carolyn. And of course, I mean, lots more outside of that. So my apologies, we've come to the end in terms of our time, but maybe just in closing, I'm gonna mention something, Carolyn, that you chatted to me about, and that is, just in terms of what type of style or strategy you should be looking at in terms of investing in this environment. And you mentioned this kind of roller coaster that we've been on over the last 2 years, going from a period of recession and COVID into what you called the roaring 20s, and then into stagflation, and then into an inflationary environment, all in a very short period of time. And it's certainly not something I think most investors are used to. But it doesn't mean that there aren't great strategies that cope with that type of flexibility. And I think one was mentioned, which is obviously going for something where you kind of have a very nimble strategy that kind of goes between various types of strategies. The other, though, is to remind ourselves that long-term investing is critical in these types of environments. So maybe if you just want to make one or two comments about how that pertains to the Global Growth Fund.
Yeah, absolutely. So that's exactly what we do. We're taking a long-term view here. And of course, the markets do swing around in terms of which style is in vogue this week, this month. And I think if you're trying to time that, then good luck to you. I mean, some funds and some strategies are set up to do that, and they're either successful or they're not. I think it can be a very difficult thing to get right if markets are moving around on a very constant basis, like we have seen. And again, because there's so much distortions from supply chain blockages because of the overhang of COVID, for example, actually forecasting the macro is very difficult. What we find easier to forecast, and where it is our key capabilities, is forecasting companies' earnings growth. And that's where we have those 90 analysts, regional analysts, and the 8 global sector specialists that are doing this day in, day out. They've done this for years. They've got an average experience of 21 years when it comes to the global analysts and 17 years when it comes to the regional analysts. So this is why we have the long-term approach. We will take a position in the stock where we see that sustained growth. When valuation looks like it's getting a bit more extreme, we can moderate those positions or sell out. But I think having that long-term, the long-term focus on value-creative growth companies, and if you can hold that through periods of market volatility and changes in styles in the market over the long run, remember that earnings growth drives the majority of the equity returns over time. And we have the chart in the pack that shows that. So really key is that consistency of delivering of the earnings, and that's what we're focused on in the global growth strategy.
Great. Well, thank you so much, Carolyn. And I think for all the asset allocators out there and client managers out there, a very important strategy to keep an eye on over the next couple of months as we see valuations have corrected. And as you said in the beginning, a great starting point, or a better starting point for a lot of growth stocks from here going forward. Thank you, everybody. Apologies, we did run over a bit, but I think it was well worth it to have that extra time with you. For all the questions we didn't get to, please contact your Stanlib BDM, and we'll be very happy to continue the conversation, and we'll make sure that we also get hold of anyone who asked us to send some data to them. Have a good day. Goodbye.